What do I want to talk to you about today? I want to talk about the elephant in the room. And it's something in Ireland that we're not very good at talking about, and that's dying. Now, let me caveat what I'm going to say is we're very good at talking about dying when it's happened. We have the wakes and we have the month's mine and we have the celebrations and we raise glasses to the dead person. We all tell funny stories about them. Very good at dealing with death once it's happened. But here in Ireland, we're particularly bad at dealing with death in advance. And frankly, as Benjamin Franklin coined the phrase, the only thing certain in life is death, and predominantly here, taxes. This whole area of inheritance tax. So what do I want to talk to you about today? I want to talk to you about the thresholds for inheritance tax, and more as importantly, how it's paid. I want to talk to you about special cases and how you can manipulate your will and your assets to fall into, at times, into certain special categories. I want to talk to you about tax-exempt assets and the reliefs that are available, some of which are extremely sizable. And then finally, talk about the legal considerations around making a will, of appointing an executor. So let's talk about thresholds. Now, you don't need me to tell you, it's fairly easy to find out. There's broadly 3 tax-free thresholds available for inheritance tax relief. The first one is parent to child, called Class A, and it's €400,000 tax exempt since the last budget. The next one is Class B. It's €40,000. It's linear relatives, brothers, sisters, nephews, nieces, and that sort of thing. And then the final one is Class C, which is strangers. People who have no relationship to the donor, but can still get a modest amount of tax exemption. That in that case being 20,000. So we've got thresholds of 400,000, 40,000 and 20,000. And the first thing I want to tell you that is worthy of consideration is using all familial allowances. I was talking to a consult recently and he was telling me about a will that his mum had made, leaving everything to him and his siblings. Now, he and his siblings had 10 grandchildren, and the assets mum was leaving behind were substantial enough to use up all the mother to parent tax reliefs. So I suggested to him that mum might consider changing her will to leave 40,000 each to each of her grandchildren. She had 10 of them. That's 40,000 by 10, that's 400,000. If that 400,000 was left to the parents, the tax liability would be in excess of €120,000. By leaving it instead to the children of the parents, the tax liability was 0. So, as you've heard me say before, it ain't what you do, it's the way that you do it. So, hopefully this example shows you that the tax liability of your heirs is not dictated by how much you leave to them. It's often dictated, or as much dictated, by how you leave it to them. Special cases and strategies. What are the special cases? Well, I mentioned the thresholds already, but it's possible at times for those in the B category threshold, having 40,000 tax exempt, for them to be able to move to the A category. And that's under a thing called preferred nephews and nieces exemptions. So if you have a nephew or niece who's involved in your business or your farm, who's working within it, you can leave them assets up to 400,000 tax exempt as opposed to 40,000. Now you do need to test this, you do need to talk to your lawyer about this preferential relief, but if you can apply it, in this case there's another €120,000 in tax that would have been paid without the preferential treatment that isn't paid. In the special cases too, it's worthy of considering insuring the liability. What do I mean by this? I was talking to somebody recently about this, and they were lucky enough to have, or good enough, I suppose, to have an estate worth 20 million. They had 3 children. And ultimately, the tax liability for those 3 children, when eventually inheriting the money, would be 6.2 million euro. Now, you might think if this person insured themselves for 6.2 million, all they're doing is making their kids richer. But that's not necessarily the case, because if you understand how inheritance tax is levied, you might consider this type of insurance far more valuable than simply making your kids richer. Here's the example I want to give you. If you die as a donor in the first half of the year, actually before August 31st in a year, so tax payable, when is the inheritance tax payable? Well, that depends on when you die. So if you as the donor die on or before the 31st of August in a particular year, your beneficiaries owe the tax the following October. If you die after the 31st of August in a year, they don't owe the tax until the next October. So I often say to people, the worst day to die from an inheritance tax point of view is the 31st of August. The best day to die is the 1st of September. So if you die on the 31st of August, maybe put yourself in the freezer for 24 hours, come out a day later, because that will give your kids 14 months to pay the tax as opposed to 2 months. Now, why is this important? Because of late payment penalties. That's why it's important. Going back to my consult recently with the 6.2 million liability, if his children delay that payment by 1 month, late payment penalties increase the liability by just short of 50,000 euro. So for every month they delay, the bill goes up by 50 grand. And as I said to him, you're not insuring the liability to make them richer. You're simply insuring the liability to make sure that they have the wherewithal to pay the tax, and they can do so in a timely manner to avoid these penalties. If you didn't do this, in this client's case, a lot of the assets were illiquid. So what they would have to do is sell off the assets to pay the tax. And if the market finds out they're selling off the assets to pay the tax, then they may get less value than they normally would. So in a case, say, for a property worth X million, let's say it's worth 5 million euro, and they sell it for 4 million euro simply because they've got this 50 grand a month increase, the revenue won't necessarily take account of the lower sale value. They have the ability to take the attitude, well, it was worth 5 million, just because you sold it for 4 million doesn't mean you owe us less tax. So the reason to pre-fund in this particular person's case was nothing to do with making the kids richer. It was to do with avoiding the fire sale of assets and avoiding late payment penalties. Now, those of you who listen to me on a regular basis know I'm not a fan of inheritance tax. I think it's a poor tax. I think it's a tax on already taxed assets. But when you consider a growing liability due to the illiquidity of assets left behind, you can see that the tax is even greater in many cases than the 33% headline. Proper planning will help you lower those taxes. And in Section 72 life insurance, which is an insurance policy dedicated to paying the taxes, and the assets of which are exempt from those taxes as long as they're used to pay the tax on the balance of the estate, can be extremely valuable tool to reduce overall tax cost. That same person I was talking about with the 6.2 million liability, we ran some numbers just off looking at various insurance policies available on the market. And the premium he'd pay to insure that liability would have to be paid for 47 years to equal the value of the tax. Now, this gentleman was in his 50s. He isn't going to live to 110 plus years of age. So, as I said to him, your children are going to use your funds to pay these taxes. So the question here is, will you pre-fund them and pay less out of those funds, or will you simply let them pay the taxes when the liability occurs? Third thing I said I'd talk to you about tax-exempt assets and various reliefs. So let's deal with tax-exempt assets for a minute. There are various assets that you can leave to the next generation, and as long as they qualify under certain relevant criteria, they will be tax exempt. Art on public display, heritage properties, businesses, perhaps agricultural land. All of these can be left at minimal value or no value at all from an inheritance tax point of view. So if you're sitting on surplus assets, assets that you know will be inherited by the next generation, then maybe from an investment perspective, you should be considering assets that will be exempt from inheritance tax. Because put it this way, even if those assets underperform the assets you already have, it's not about how much you can grow it to in your lifetime. It's about how much net value the children are going to get or the heirs are going to get. So you can have an asset like art on public display that underperforms the asset you already hold, and still the kids or the heirs will get more than they would have if you continue to hold the assets that are liable to tax. Reliefs, the two major ones, business assets relief and agricultural relief. Business assets relief, notwithstanding recent changes, broadly speaking, you can give assets at 10% of their value if they're what are called qualifying business assets. Now, the recipient has to hold on to those assets for 6 years beyond getting them so that they retain the relief. But in that case, a €1.5 million business can be passed to the next generation at a taxable value of 150,000, which is less than the 400,000 parent to child, which means a tax-exempt transfer. Agricultural relief, little different, because agricultural relief only applies if the person receiving the gift or inheritance passes the farmer test. Now, for you and me, a farmer might be somebody who puts on Wellington boots, goes out 5 o'clock in the morning and feeds the cows. And that sounds like a farmer to me, but that's not a farmer as far as the revenue farmer test is concerned. Part of that test is after receiving the asset that 80% or more of their assets are agricultural. So, years ago I had a client who had a farm, a very valuable asset. He had other assets that were extremely valuable as well, totaling about 10 million, and his will said, I leave everything to my wife if I die first, and I leave everything equally to my children. Now, the problem with that will was that meant that neither of his children would get agricultural relief. So the planning opportunity for him was to change his will, to leave the farm assets to one child, leave the other assets to the other child. They were roughly of equal value, and the child getting the farm assets could then pass the farmer test and receive the agricultural relief. The final thing I mentioned I'd talk to you about is the legal issues and executors' considerations. I was talking to a friend of mine recently, and they were telling me about a case where the executor of the will was one of the beneficiaries. And the problems that arose is that there was a property in that will which had to be sold by the executor, and then the assets divided evenly amongst him, in this case, and his siblings. Because he was the executor, he was able to sell the property to a mate at a relatively discounted value and disadvantage his siblings. Now, I'm not saying every human being will do that. I'm not saying every human being will feather their own nest if you give them the opportunity. But what I am saying is it's possible. And in this case, it was only possible because the executor had a conflict of interest. So question your executors, question your choice around that. Make sure that your executors do not have a conflict of interest. And that leads me on the last two examples to the last piece of, the last recommendation I will make to you. And that is to itemize assets. This idea, I mean, we did a video recently that says only 27% of Irish adults have a will at all. And the vast majority of them have a will that says, I leave everything to my wife, or I leave everything to my spouse, I leave everything to my husband, and equally to my children. Now, the problem with that is you're forcing your children into partnership down the line. So let's say there's a property, let's say there's a business, let's say there's a farm. Now you've got a property or business or farm owned by 3 individuals as opposed to 1 individual. You've turned what used to be a dictatorship where you made all the decisions into a democracy where 3 people make all the decisions. And who's to say those people are at the same point in time in their lives? Who's to say that some of them are married and some of them are not? Some of them have children and some of them do not. And no matter what the difference is between them, they are each likely to want something different from their inheritance than their siblings. So my suggestion to you is to itemize your assets, to recognize that if you can leave individual assets to individual people, then they have free and unencumbered use of those assets. They don't have to go to their brother or their sister to ask permission to do something. And it avoids conflicts. So inheritance tax, death is inevitable. Taxes not so much, but death is certainly inevitable for us all. My point to you guys is that discussing this in advance, you know, there's a, as I said at the very start, Irish people are very good at discussing death when it's happened, but we're really poor at discussing it in advance. For those of us at the donor side, we don't want to appear greedy. We don't want to be telling mum and dad that we're hoping they shuffle off this mortal coil soon. For those who are leaving the assets behind, especially for the older generation, they tend to keep their financial cards very close to their chest, almost embarrassed to have money. And that means that we're not talking about it. But hopefully what I've proven through this video is that talking about it, making subtle tweaks and changes to a will, subtle tweaks and changes to what you say you want to happen, not only can save hundreds of thousands of euro in tax in the examples I've given, but can also ensure that your family don't fall out. There was a famous pub in Rathgar, I won't name it, but many years ago it broke the headlines in newspapers because Dad left it to 3 sons. And when I think the value at the time was about 7.5 million. And when the sons were finished fighting over it, they'd paid 4 million in legal fees and each walked away with 1 million. Now that wasn't Dad's intention. But the problem here is that each of those brothers, I imagine, and I don't know this for a fact, but I imagine have different ideas about what to do with the pub. One maybe wanted to run it, one maybe wanted to lease it to somebody else to run, one maybe wanted to sell it. So how do you square that circle? Well, in that case, either you simply say to your executor, sell the asset and give them the money, or you appoint, as we've talked about before here, one of those, in that case, one of those beneficiaries to have what is called a golden share. In the event that they can't agree, somebody has to make a decision. Death is inevitable. The taxes on death are not. And the only way that you can ensure that your assets are exposed to as little tax as possible is through forward planning, through about talking about it in advance, deciding what can be done from a splitting assets point of view, from an application of reliefs point of view, from an insurance point of view, and then putting those plans in action so that you save taxation, you deliver your hard-won life's work that that most of us built up for our children, that we deliver to our children free and unencumbered and without forcing into the World War III over the money we leave behind. Solicitors can help you with the legal side, but the only people who can help you on the planning side are truly impartial financial planners. If you don't have one on your team, it's time to add them.